Well, hello, Damien. Thank you so much for joining us today for our ESG Investment Influencers series. Good to see you again.
Thank you. It's a pleasure to be here.
I wanted to start this interview just by asking you about your own career and what's really driven your passion for sustainable and ESG investing. What sort of really grabbed you about this area?
I have to say that I've been very lucky. So I used to work for an American investment bank, Merrill Lynch, started when they were just about to go bankrupt, and did 4 years with them and was an investment manager there, but we never talked about ESG or sustainability. But as I was kind of working on that kind of next kind of career move, I came across EQ and this idea of impact investing. So that was back in 2011. The term has just been coined after a research report from JP Morgan. So this is very nascent, and ESG was not really, or sustainability was not really a topical subject, but I found the idea of trying to making sustainable investing more mainstream quite interesting challenge to get involved in, and but without knowing much about it, I'll be very honest with you. And it's been a journey where after every meeting, then I've learned, a little bit more about the subject. And then as you learn more about the subject, then you realize how big the problems are. And then you become more passionate about how you can help solve them. So that's, on my side, is not, I don't really have that kind of eureka moment. It's more like, I've grown with the space, basically.
And that's a huge change you've seen over that period since you started working in this area. This is a part of the market that's is in the mainstream now. It's a huge area that everyone is talking about. That's a big change, isn't it?
No, you're absolutely right. People were looking at that back then as people being like a tree hugging, and now actually everyone is kind of jumping in the bandwagon. I need to have a sustainable investment fund in my proposition for my clients. So times have changed. I guess the concept has been tested through up and downs. And I've done quite well to the point that now people really realize the interest of embedding sustainable investing. In one form or another, everyone will have a different view of how they think they should be done into their process.
And I know we will come on to talk about this later in more depth around where the industry can go now to really help investors here. But where do you see some of the big challenges in the sector at the moment, especially around that awareness and how we can inform people about this area?
Well, I think like you, Katrina, the first main thing to focus on is education. Either being the advisors, actually I shouldn't say that too loud, but often the fund managers as well, and the end clients. All those kind of stakeholders needs to better understand sustainable investing or the concept of sustainability, and see how they can basically integrate that within their process or within their proposition or within their investments. And we need just to tell them why that makes sense for all of those stakeholders. And we're still not there yet. And the good news is, we're supposed to see regulation pushing this. Obviously, with some Brexit uncertainty, we don't know exactly what's going to happen, but we know the direction is there. So I think, education is still the main one. I think, we clearly as well need to have, there's sometimes a little bit on the offering side as well. There's some asset classes that are clearly overlooked. I think, equity is relatively well covered, but, fixed income, alternatives, infrastructure, property, all those asset classes really would benefit from a much better integration around ESG issues. So I think this is clearly one. And on the passive side as well, sustainable investing historically was just actively managed funds, and you just had to accept that. It's good to see some innovation within the passive industry, but there's so much more to do there. So I guess education and deepening the offering will be probably, for me, the two key hurdles we'll still have to overcome.
We're going to go into a lot more of those issues a bit later, and including how you sort of guard against greenwashing when you're sort of analysing some of these propositions. But maybe just briefly for our audience, you could maybe just describe the structure of your sustainable investment offering for clients. How have you sort of structured the range?
Sure. I mean, historically, we went very much kind of dark green into impact investing, and that's how we got involved into sustainable investing. So these are actively managed model portfolios, the range of eight risk graded model portfolios, so that each client can have a model portfolio aligned with their kind of the risk attitude. And on top of that, we also have a more recently launched sustainable passive proposition, which is benefiting from the recent development within the passive industry. And because we realized a lot of people like the idea of sustainable investing or sustainability being taken into account their investment proposition, but not really willing to pay for actively managed funds. So that is, so if you want, there's really these two offering we have where, we're trying to cater to all type of investors. Those are very passionate, which we'll probably find more into the impact investing camp, and those that like the idea, but probably want to keep costs low. So that's how we've structured our proposition that advisors quite like, actually, that the idea is to be kind of a one-stop shop, so to speak.
Well, let's look at the passive side, maybe, as you've been touching on that quite a lot. In terms of the due diligence there on strategies to put in there, what are key things you are looking at? And maybe you could also touch around exclusions in that area, because I know that's an area of a great deal of interest for a lot of our readers as to how some of these indexes are put together.
Yeah, I think, when it comes to sustainable investing and passive, there are really kind of two camps I need to look at. There is the ESG indices, and then you've got the thematic indices. So if we start with ESG first, it's, obviously with passive, this is rules-based. So, the first thing you need to look at is the methodology. And well, the bad news, I guess, for advisors is that there are, I want to say hundreds of different ESG indices. So it's quite complex. So you need to really understand, to your point, what do they screen out? Then when they embed ESG into their process, how do they do it? Do they overweight leaders, underweight laggards, just focus on the leaders? Do they focus into improvers? Yeah, I mean, this is really the two key things you need to look at. And then obviously look at, how they're getting with this ESG rating in the first place, because there are many rating agencies, but they don't look at ESG in exactly the same manner. So I guess, that's the first challenge, is that because you've got so many indices, you need to basically get your hands dirty a little bit and understand, because what I find, to your point around greenwashing, there is a range of indices called ESG screened. So, and what they only do is sector exclusion. So from memory, they exclude 6 sectors. So, but they don't do any kind of ESG look through at all, or any kind of selection using ESG data. This is just an exclusion approach, like quite a ethical approach, but nothing to do with ESG really. So I guess, really go beyond the name or the fact that you've got the acronym ESG in the title, and really kind of look at the the top holdings. Usually kind of the sniff test. If you see Facebook, if you see Amazon, well, maybe just really ask yourself whether you think they are really good companies you would expect. I mean, just to give you an idea, Facebook is one of the worst rated companies from an ESG point of view. So if you see Facebook, then clearly in the top 10 holdings, clearly that means that this strategy is probably not taking it seriously. So that's the ESG kind of index funds and ETFs you can find. And then you've got the thematic. And this is where we see a lot of innovation at the moment. there are some big players like iShares, for example, like iShares. There are some newcomers like LNG, like Rise, and a few other. And really, the idea is that they look at a system of themes, usually build their own indices. Kind of this idea of they call them passive active indices, just to make it even more complicated. But it's quite interesting. You've got some very exciting clean energy trackers or healthcare trackers or water trackers, which actually could make a lot of sense for people that want to embed sustainability within a portfolio while maintaining cost low. And finally, the great news is that there's more and more competition, so cost is coming down. And I guess that was one of the biggest barriers with kind of sustainability and passives, is that as there were very few of them, you were paying the same price as an active fund. So why then not going for active?
So in your passive portfolios, you'd have a mix of those different types of strategies, would you?
Yes, exactly. I mean, the way we build them is that we want to be very ambitious. We're ambitious first with the ESG screening, so focusing on the top quartile ESG rated companies across the sectors left once we've done a relatively ambitious negative screening exclusion approach. And then what we do, we then have a satellite approach where we overweight themes that we've defined as being sustainable. So for example, clean energy, green bond, healthcare, with a view to focus on those companies that really help to build kind of a better world. And actually I came in the passive side with relatively kind of an open mind, and it's actually quite exciting. So I really encourage everyone to have a look at those. I think there's some exciting portfolios that can be built for clients.
And what about the engagement of passive providers with companies? I think that's a big debate issue, a big discussion that investors might be concerned about. So they're maybe not using their clout as much as they could be to bring about these changes. What's been your sort of assessment of that?
Yeah, I can't agree more with you. And this is a really important topic. There are some, what I would suggest, obviously, is to really go beyond kind of the headlines. There are some very famous CEOs that make some quite bold statements about how important sustainability is for them. But there are some really interesting reports put together by people like Share Action, looking at climate change resolutions. And if you see some asset managers that are voting in 90% of the cases against resolutions that are basically asking for climate change to be taken into account, a company's kind of a process, this is really kind of a massive red flag. So I really encourage people to have a look at Share Action's reports, and there are a few other people doing the same analysis. The good news is, thanks to people like Share Action, there's been a lot of pressure put on those asset managers, and clearly there's a positive momentum building up. So we can see year on year how those asset managers are being better rated. Just to make things slightly more complicated, climate change resolutions, for example, there are not that many of them. A lot of the progress that you get from companies is through the engagement you have kind of on a regular basis, probably through emails or management meetings. And this really happens behind the scenes. So it's quite important to do due diligence with the index providers you look at, and just to try to understand, what do they actually do. And because they've got so many companies, probably they need to be pragmatic and maybe just focus on a few topics, but make sure you get evidences that on those specific topics, they're really getting companies to improve their practices. And some are quite good at it. And I'm happy to mention a few names. Some people like Amundi, for example, people like UBS are quite well rated, and definitely people you can trust. Definitely is not perfect, but much better than many of the largest index providers you can think of.
And I'm just moving on to the active side then. When you're doing due diligence on the active side for funds, what are really key areas that you're looking at? And I suppose where would be the red flags as well if a fund group's coming to you with a sort of proposition there?
Well, I guess, you know, probably what's worth saying is that there is definitely kind of a spectrum of, you know, when it comes to sustainable investing. So as far as we're concerned, you know, the bar is really high, really focusing on strategies where the core focus is into innovative product and services, tackling social and environmental issues. So for us, actually, before we even accept a meeting, we ask for the full list of holdings. And we've got kind of a matrix we've developed just to find out whether those holdings are really helping to contribute to solutions. So this is a bit frustrating for fund managers because they want to pitch us their strategies, and we say, well, we're just going to see whether what you're doing is of interest to us. And once we see the holdings, then it's interesting to understand how did they get there, and obviously through a review of the process. And often, you know, getting the fund manager to explain the process is definitely worth doing. To your point around engagement is really important on the active side as well. And one side which is often overlooked with impact is actually the highest impact we make through listed investments is through the engagement. So you just can't not focus on engagement is really important. So we want to make sure, again, that we have evidences from the fund managers that they're engaging with companies, but also they're happy to take bold decisions if the companies that they've been engaging with for some time are not moving in the direction that we're asking them to do. So, so that you just want to see through maybe examples where they're kind of walking the talk.
Yeah, that's right. And what about looking at the wider fund group? You know, it could be a great fund they're putting in front of you, but how much work do you do around the sort of the provider behind that?
Yeah, I mean, that's, sorry, that's quite a tricky question. The way we look at it is you start with the strategy itself. Whether, you know, the strategy itself and the team alongside the strategy is taking this issue very seriously, and because there's some boutiques, for example, where each team is quite independent. So actually, what might happen, kind of within other teams within the business, might not be that relevant. Having said that, to your point, you're absolutely right that it's quite hard to push for an asset manager, or for a fund with an asset manager where most of the assets are not really run in a systematic manner, or are not, you know, for example, being not the proxy voting, for example, are not being used to get companies to do better. So there's some big names out there that for us, we've been relatively reluctant to engage with some impact strategies they may have launched, because we think that the reputational risk is high, and also because we think they're not really kind of walking the talk. So, but it's you need to be pragmatic a bit as well. So if you can see kind of a strong commitment from an asset manager to do better, quite happy to support them, particularly if they're willing to listen to the feedback we and many other investors might give, because that's really how, you know, if you engage with $1 trillion asset manager and you get them into this sustainability pathway, that means the end result is going to be quite massive. So restricting yourself just to boutiques, although we love boutiques, you might miss on actually the massive impact you could have through getting some of those maybe not so good players to become better. Yeah?
Maybe could you also maybe highlight a couple of funds that you've either taken into the portfolio recently or attracted your interest recently, and sort of explain why?
Yeah, I mean, a recent addition in our portfolios was the 91 Global Environment Fund. It's interesting, historically we've always had exposure to environmental equities through the likes of, like I want to say, kind of a specialized boutique like Impacts, for example, Impacts Asset Management. But what was very interesting for us post-pandemic, I should say, so post-April, and as we were kind of focusing on building back better, it was quite clear that there will be a massive focus on decarbonization. So we really wanted actually to further sort of increase our exposure to the space by focusing on a dedicated strategy. So we've known the strategy for quite some time. I mean, it was launched in 2019, so we just looked at how the strategy just progressed with very established fund manager that has been working in the field for like, I think 15 years. So as they joined 91 and launched this strategy, we just looked at it very closely, and they launched a UK version of the strategy, and we decided to get involved, and that has been a fantastic performer for us. But we think that this is a theme which is not going to go, just not going to disappear. This is here to stay, and if anything, they're going to more and more focus there. So that's one fund we added recently.
And I know, sorry, on that topic, obviously an area we're doing a huge amount within our company with the Net Zero Festival that we've been running. But I know it's an area we talked about because it's an area where you think that there needs to be more done now to sort of standardize the measurements in this area and some of the ratings.
No, I mean, you're absolutely right. I mean, there's I mean, carbon is a very complex topic, as you know. And we learn every day on this. Earlier in the year, we started partnering with a company called Urgentem, who is a data provider focusing on carbon. And because often people look at what we call scope 1 and 2 of carbon, but what they don't look at is carbon emissions coming from the sort of the supply chain. And for many companies, and actually for most companies, most of the emissions come through your supply chain. So you really need to look at all kind of the different scopes. And now we're starting to get more data, and companies really are being asked to provide that data, really helping you to basically better I want to say risk-proof your portfolios against the decarbonization risk. I mean, 2020 was a great example of if you had very high carbon emissions, then basically you would, I mean, if I generalize, you would underperform the overall market. And this is what happened, for example, with the energy sector or the mining sector. So people just can't overlook carbon emissions anymore. You're absolutely right. So I think there's two things. There is, you need to think about probably reducing carbon emissions at the portfolio level. This is to kind of reduce the risk of stranded assets and sort of downside risk. But then you also need to think about whether you want to benefit from this transition, and because there's some solution providers which will do really well on behalf of that. So I think this is the two sides that really we want to play out with our propositions.
And I'm just coming back to your other fund choice. Can you name another one for us that you've been looking at?
Yeah, I mean, I mean, if I just take maybe a fixed income fund, we at the beginning of last year we introduced the Wellington Global Impact Bond Fund. This is, in our opinion, a very underlooked fund. I mean, it's fair to say Wellington Asset Management is a relatively unknown asset manager in the UK. I mean, they manage about $1 trillion, but primarily in the US and in Asia. And they're relatively famous in the impact space because they launched a global equity impact strategy, from memory, back in 2016, for which they actually had a good track record. And they put the bar really high for any companies to be included in the portfolios. And their reporting was quite really kind of a first quartile. And we engaged with the fund manager, a chap called Camp, a while back before the fund was launched, and the fund was launched at the end of 2019, with a view that we were kind of missing tools to invest with an impact, but outside kind of the sterling issuance. And this fund focusing primarily into US credit. So, and they kind of apply the same impact process where the bar is really high for any companies to be, or organizations to be included in their strategy. And it's quite interesting as well, it is a relatively kind of low risk strategy. A lot of the kind of ethical, sustainable strategy you see out there have a lot of credit risk. I mean, you look at what happened in March. A lot of these funds doing gathering a lot of assets in the UK with ethical or sustainable investors really suffered in March. So you really need to think about your fixed income allocation and think about how much credit risk you want to take. And Wellington Global Impact Bond Fund can help you reduce that.
And I wanted to ask you as well, we've been talking about the underlying funds in your portfolios, but how do you measure the impact of your portfolios there, and how do you sort of communicate that to clients? Because obviously it's the big question they're asking as a total, what your impact is.
But you're so right. We get that question every day. I mean, you talk about carbon. So measuring carbon obviously makes sense from a risk management point of view, but also from a reporting point of view. You can explain to clients whether your portfolios are aligned to a 1.5 degree scenario, for example. So there are some tools helping you to do that. So can reassure them that the portfolios are on track. So that's one way. Obviously, another way, you can also look at whether your portfolios are helping to contribute to the goals. And there's ways you can map your portfolios to the United Nations Sustainable Development Goals. That's another thing we do. And then, but for us, this is probably not going far enough. So what we, alongside a few kind of asset managers, we've kind of helped define and refine ways to measure impact, but looking at the underlying companies themselves and really focusing on the product and services. If you invest in a company which is developing a new vaccines, for example, which is quite topical, how many patients have you been able to help being vaccinated, for example? If you are investing in a company which is developing renewable energy infrastructure, how many kind of additional capacity have you added to the grid? And with that information that you can aggregate across a number of companies, then you can really start measuring the impact at a kind of a portfolio level, which really, really the idea here is to bring impact to life. By no means this is perfect, but the end client, what they want to understand how you're making an impact. But so that's, obviously there's kind of an interesting sort of storytelling here. But from a portfolio management point of view, you get to know the companies really well, and you can challenge the fund managers on why do you have that company, because the impact data we're getting from this company is not exactly what we'd expect to see in your portfolios. So this additional information, you can really challenge fund managers on why they hold a specific kind of company. And because a lot of engagement is often done on the back of, let's say there's some news bursting around a company, and then you engage, why do you have exposure to that company and what you've done? And actually, this is only part of an engagement work. It needs to be kind of a little more kind of an early stage where you really want to understand the case for that specific company to be in the portfolios.
Yes, and that's definitely been a shift we've seen, hasn't it, to people talking a lot more about impact. But what that means is obviously presenting a lot more of this data and really analysing that. It's not just someone saying they're doing ESG investing or even impact investing. It's really demonstrating what that is, and for you to the clients as well. Just finally, I know we have touched on a lot of this during this interview, which has been really interesting. But what would you like to see now from the industry in this stage of its sort of evolution? What's really going to be really important going forwards?
I think, from an industry point of view, we need the people with the, having the reins of those large firms to really kind of embrace sustainability, because there's often a disconnect between the story they tell clients and actually what they do behind the scene. Don't get me wrong, there's some really good sort of asset managers out there, but there are, in our opinion, too many that are just not ambitious enough and still quite, I think, quite behind in terms of ESG integration, and then embedding all sustainability risk, but also thinking about sustainability kind of opportunities. There's always the two sides of the equation you need to look at. So that's the focus for us as an industry. I think as an industry as well, we can't preach things that we don't do well ourselves. So diversity is quite topical. As a firm, we really promote diversity, being gender, being as well sort of from minorities, and there's some kind of, again, bold statements being made, but there's still, I think, not enough being made. I mean, for example, on our side, really keen to, improve gender diversity within the investment team. And what we realize is actually you need to start and offer more kind of graduate kind of positions and help actually young women to get into the industry because so that, you find then more at a kind of a higher seniority level. So I think, I mean, that's really what we do as an industry, is that we do what we preach, so that we have probably more sway in our discussion with companies, so that we can tell them this is what we've done. There's no reason why you shouldn't be able to do it as well.
Yes, and we are seeing that shift with investors really looking at those wider companies. If they're saying that they have that great diversity record, well, show us what's there. And if you're showing an investment team that isn't diverse and you're saying that you're embracing diversity, then there's clearly a huge mismatch there. So I think we will see a lot more people probing in those areas, and rightly so. Well, thank you so much for that, Damien. That was really great insight into what you're doing and where we are on this journey in this really interesting sector. So thank you so much for your time. Take care.
It's been a pleasure,
Thank
Katrina.
you.